Running a small business in Canada? Then you already know that corporate tax can feel, well, like an impossible puzzle. But what if I told you that in the next few minutes, we could give you the key pieces to solve it? That's exactly what we're going to do. By the end of this, you'll be able to navigate the system with a whole lot more confidence. I should mention this explainer is based on material prepared by Dr. Samir El-Rashani. Okay, with that, let's dive right in. Here's the roadmap for today. We're going to tackle 4 crucial areas. First, we'll lay the foundation with Canada's two-tax system. Then, we'll get into the biggest advantage for small businesses. That's the CCPC status. After that, we'll dig into why not all income is treated the same. And finally, we'll unravel how taxes work when your business operates across provincial lines. Okay, let's start with the absolute bedrock of corporate tax in Canada, and it's this simple fact. Every single corporation faces 2 layers of tax, not just one. This is what we call a combined tax system. So think of it this way. The federal government sets a base rate that everyone pays, no matter where you are. But then, each province and territory gets to add its own tax rate on top of that. The key thing to remember is that your final tax bill is always a blend of these 2. So, to put it really simply, where your business earns its money has a direct impact on your bottom line. A company in Alberta is going to have a different final tax rate than the exact same company in Nova Scotia. It all comes down to this dual-layer system. And this simple fact leads us right into our next and probably most important point for small businesses. Now, let's talk about what is, without a doubt, the single most important concept for small business owner in Canada. It's the CCPC designation. Getting this right is the key to unlocking some really significant tax savings. So what on earth is a CCPC? It stands for Canadian Controlled Private Corporation. And for tax, it puts you in a very special category. You see, on one side, you've got CCPCs. They get access to this amazing benefit called the Small Business Deduction, or SBD. On the other side, you have general corporations. Think big public companies or foreign-controlled ones, and they just pay a higher flat rate on everything. And just how big of an advantage are we talking about? Well, it is huge. Look at this. For a CCPC in Ontario that earns $500,000, being eligible for the SBD means paying over $71,000 less in tax than a general corporation with the exact same income. That's a staggering 54% tax cut. So how does this work? The magic is all in the small business deduction. At the federal level, it drops your tax rate from 15% all the way down to just 9%. Now, this applies to the first $500,000 of what's called active business income. That's basically the money you earn from your core operations, like selling your product or service. And that 6% federal drop is just the start. And this table shows you exactly how the provinces layer on top of that. You're looking at the combined federal and provincial tax rates for small businesses. You can immediately see that places like Manitoba and Saskatchewan are super competitive, with a combined rate of only 9%. And notice, Saskatchewan even offers a higher SBT limit, up at $600,000. That's a serious leg up for a growing business. Now, I just used that term active business income. This brings us to our next really critical point. For a CCPC, the type of income you earn is just as important as how much you earn. The tax treatment is worlds apart. So you're probably asking the logical question. Great, so my CCPC gets that nice low small business rate on every single dollar it brings in, right? And the answer, which probably won't surprise you when we're talking about taxes, is a firm no. This chart just says it all. The difference is just, wow. On the left, you've got your active business income, taxed at that nice SBD rate somewhere around 9 to 12%. But look at the right. That's passive investment income. It gets taxed at a combined rate that can shoot past 50%. The difference is absolutely staggering. So what is this highly taxed investment income? It's basically money your corporation earns without actively working for it. You know, things like interest from a bank account, dividends from stocks you own, most types of rental income, royalties, and of course, the taxable half of any capital gains. The government's goal here is pretty clear. They don't want people using corporations just as a personal piggy bank to delay paying taxes. Okay, I know that 50% tax rate sounds incredibly punishing, but there's a really important mechanism called the refundable dividend tax on hand, or RDTOH. Here's the deal. A big chunk of that high tax isn't gone forever. It's put into a special imaginary account. And when the corporation pays dividends to its shareholders, that money gets refunded back to the company. The whole point of this complicated system is to achieve something called tax integration, to make sure that in the end, there isn't a huge tax advantage or penalty for earning investment income inside a company versus earning it personally. So, we've seen how federal and provincial taxes work together, and how different kinds of income get taxed differently. But what happens when your business isn't just in one province? For our last section, let's tackle the rules for when your business expands. And this is where it can get a little tricky. So, if your company has operations in, say, both British Columbia and Alberta, how does the government decide which province gets to tax which slice of the pie? You don't just get to pick the cheaper province, unfortunately. There's a formula for that. Now, the whole system is triggered by having what the Canada Revenue Agency calls a permanent establishment. This is a really key legal term. It basically means you have a fixed place of business, an office, a factory, even just a warehouse. If you have one of those in a province, you have a permanent establishment, and that means you're on the hook for taxes there. It's the government's way of making sure tax gets paid where the actual economic activity is happening. So, how does the formula actually work? Don't let the brackets scare you. At its heart, the government is just looking at the two main engines of your business, your sales and your people. This formula takes your sales revenue and your payroll and uses them to figure out what percentage of your profit was earned in each province. Let's see how the pieces fit. Okay, let's break down those two parts. The gross revenue percentage is pretty straightforward. It's just the revenue you made in Province A divided by your total revenue from everywhere. The salaries and wages percentage is the same idea. Payroll for your team in Province A divided by your total payroll. The formula basically assumes that when you sell and where you employ people are the best indicators of where you're creating value. And this is a perfect example of how it all works in practice. Imagine a company, ACO, has a taxable income of $100,000. Half of its revenue, 50%, comes from Province A, and 60% of its wages are paid to employees in Province A. The formula just averages those two numbers, 50% and 60%, which gives us 55%. So $55,000 of ACO's income will be allocated to Province A, and that's the amount that will be taxed at Province A's rates. So let's just quickly recap the big takeaways. First, Canadian corporate tax is always a mix of federal and provincial rates. Second, for small businesses, the CCPC status is your ticket to massive tax savings through the SBD. Third, there is a night and day difference between how active business income and passive investment income are taxed. And finally, if you operate across Canada, your profit is split up between provinces using a clear formula based on your sales and your payroll. Even Albert Einstein thought this stuff was complicated, so if you've ever felt a little overwhelmed by it all, trust me, you are in very, very good company. The goal isn't to memorize every single rule, but to understand the core framework, which, after this, you now do. And that leaves us with one final big question for you to think about. Now that you have this foundational knowledge, take a fresh look at your own business. Is your structure truly set up to get the most out of those CCPC benefits? And is your tax planning aligned with where you actually make your money and employ your team? Something to think about. Thank you for joining me.